Imagine you're just sitting in your living room, right? You're drinking your morning coffee, and suddenly a wrecking ball just crashes straight through the wall.
Oh, wow. Yeah, that'll wake you up.
Right. But it's not like a demolition crew there to destroy the house. A whole construction team immediately swarms in and they just start building a massive high-tech server farm right in your kitchen.
Just right over the breakfast table.
Literally. They are running cables over your dining table. They're swapping your fridge out for a liquid cooling system. And they are completely ignoring the fact that you still live there and, you're just trying to finish your breakfast.
Yeah, I mean, it's a violently disruptive re-architecting of the space you thought you understood.
Yeah.
You're watching the very foundation of your house being ripped up to build something entirely different.
Yeah,
And you just have to figure out where to stand so you don't get crushed.
exactly. Well, welcome to this deep dive. Today, we are mapping out how the world's biggest companies are tearing down the old world to build a new one.
And it is happening fast.
So fast. We are looking at a massive reallocation of resources happening all around you right now, from the sheer human cost of the AI gold rush to a literal battle for real estate in the stars.
Yeah, the space stuff is wild.
It really is. And we're going to look at how all of this invisible corporate warfare trickles down to, like, the coffee you buy, the car you drive, and the medicine in your cabinet. Okay, let's unpack this. We are witnessing the architecture of the next decade being built in real time.
We absolutely are.
Mhm.
And the overarching theme we are seeing in the data is a massive, relentless pivot in capital.
Right.
Both human and financial. I mean, companies are looking at the calendar and panicking. They're desperately trying to buy time, buy infrastructure, or, buy consumer loyalty.
It's a complete rewiring of the global economy's priorities.
Yeah, and the speed at which it's happening is, frankly, staggering.
It is. I think the best place to start is with the rawest, most visceral example of this restructuring. The human cost. We've been reviewing the internal fallout at Oracle, and it is brutal. On March 31st, Oracle laid off an estimated 20,000 to 30,000 employees. Let that number sink in.
That is massive.
It's roughly 18% of their entire global workforce, just gone. And it wasn't like a town hall meeting. It wasn't a conversation with a manager. It was a 6 a.m. email signed simply by Oracle leadership.
Yeah, I mean, it is the ultimate expression of the corporate machine at work.
Yeah.
A completely automated, faceless dismissal before most of those people had even poured their first cup of coffee.
Right.
And the severance package was standard, but cold. 4 weeks of base pay plus 1 week for every year of service.
Wow.
But the mechanism of the firing isn't even the most shocking part. The why behind this is the real story. Oracle needed to free up a massive amount of cash flow, an estimated $8 to $10 billion.
Wait, okay, let me make sure I'm wrapping my head around this. They are freeing up nearly $10 billion in human payroll to fund a massive $50 billion AI data center build-out. But the part that just blows my mind is who they fired. To fund this AI future, they gutted their own cloud engineering division, the Oracle Cloud Infrastructure Team, OCI.
Yeah, which seems counterintuitive.
It sounds exactly like selling your car for gas money. You are firing the very engineers you presumably need to support the cloud infrastructure you are pivoting toward. How does that make strategic sense?
Well, what's fascinating here is it sounds contradictory until you understand how big tech views the battlefield right now.
Okay.
In this current phase of the AI arms race, human capital is no longer the most prized asset. Hard infrastructure is.
Like the physical stuff.
Exactly. We're talking servers, data centers, GPUs, industrial cooling systems, concrete, physical metal.
Right.
They are looking at the landscape and deciding that the limiting factor for their future survival isn't having enough brilliant human engineers. It's having enough raw compute power. They're literally trading 30,000 human livelihoods for silicon and electricity.
So they are betting that the machines will eventually figure out how to run themselves, so they just need to build the biggest machine possible.
Precisely.
But, while Oracle is trading humans for hardware, we have another situation showing what happens when you push that AI pedal to the metal without looking at the road. Anthropic.
Oh, man, the Anthropic leak.
Yeah. They're one of the absolute heavyweights in the AI space, and they accidentally leaked their own highly guarded Claude code.
Yeah, it was a 59.8 megabyte file.
Right, labeled release 2.1.88, and it was just sitting there publicly on GitHub because of a simple human error.
A completely routine release packaging mistake. Someone pushed a button they shouldn't have. But, I mean, the contents of that 60-megabyte file are incredibly revealing about where AI is heading for the consumer.
Because developers found unreleased features.
Exactly. Independent developers immediately dove into the code and found things Anthropic had been hiding. For instance, they found references to something called Kairos. This appears to be an autonomous agent mode.
Meaning what exactly? Like, it can browse the web for me.
Much more than that. An autonomous agent doesn't just answer your questions. It executes complex, multi-step actions on its own.
Really?
Yeah. You could tell it to research a topic, draft an email based on that research, log into your account, and send it, all without you intervening.
That is wild.
But perhaps even more fascinating, the code revealed a Tamagotchi-style buddy system.
Wait, a Tamagotchi? Are you telling me my cutting-edge AI is going to need me to feed it digital snacks and give it head pats so it doesn't get sad?
I mean, it sounds trivial, but it points to a deliberate strategy to anthropomorphize AI, to build an emotional dependency between the user and the software.
Wow.
But the reaction to this leak is where the real drama is. Anthropic is frantic. They're issuing copyright takedown notices left and right to scrub this proprietary code from the internet.
Right, but the coding community is just running circles around them.
Oh, completely.
And the way they are dodging these legal takedowns is brilliant. They are using AI to rewrite the leaked code into different programming languages like Python and Bash.
Yeah, let's break down why that works. If you have a piece of code, there is the functional logic, what the code actually does, and then there is the syntax.
Like the language it's written in.
Exactly, the specific words and symbols used in that particular programming language. Think of it like translating a book from French to Spanish.
Okay, right.
The plot, the characters, the logic of the story are the exact same,
Yeah.
but the words are entirely different. So when Anthropic's automated copyright bots scan the internet looking for their specific French text, they skip right over the Spanish version.
That is incredible. So the developers are using generative AI to alter the syntax, preserving the crown jewels of the logic, and evading the legal bots.
Yep.
It's wonderfully ironic. The very technology Anthropic is trying to dominate generative AI is exactly what the community is weaponizing to ensure their leaked code stays online forever.
Yeah, no, for sure.
It really shows that in this mad dash to dominate the future, absolute control is an illusion.
Precisely.
Yeah.
And that illusion of control is pushing these tech titans to look beyond the server farms on the ground.
Right. Because here's where it gets really interesting. It's wild to think that space, an infinite void, is suddenly a crowded real estate market.
Very crowded.
But that's exactly what's happening. The desperate rush for technological dominance is moving into low Earth orbit. We have reports that Amazon is in talks to acquire a satellite telecommunications company called Globalstar,
Yeah.
and the price tag is $9 billion.
$9 billion. This is a classic case of a corporate giant trying to close a massive competitive gap overnight with a checkbook.
Right?
Amazon has its own satellite internet initiative.
Yeah.
It was originally called Project Kuiper, now referred to as LEO, but they are vastly behind schedule and behind the competition.
Yeah, to put that into perspective for you listening, Elon Musk's Starlink currently has over 9,500 active satellites up there, serving millions of users globally.
Yep.
Amazon's LEO, they have roughly 180 to 200 satellites in orbit.
It's nothing.
That is not a rivalry. That's a rounding error for Starlink.
It is, but it's a rounding error that comes with a ticking clock.
The FCC deadline.
It's exactly. Amazon is staring down the barrel of a Federal Communications Commission deadline. The SEC requires them to have 1,600 satellites launched and operational by July 2026.
Wow.
If they fail to hit that number, they face severe regulatory consequences, which could include losing their spectrum rights entirely.
Oh, wow.
And without those rights, the project is dead in the water. They simply don't have the time to build and launch 1,400 satellites. So the strategy shifts. Buy Globalstar to get an operational network instantly.
Oh, okay, this is the part that is absolutely fascinating. Globalstar comes with a massive unavoidable catch. Apple already owns a 20% stake in Globalstar.
Yes, they do.
And as part of that previous investment deal, Apple legally locked down 85% of Globalstar's network capacity.
Which is huge.
Right. They reserved it entirely for the iPhone's emergency SOS texting feature.
In the corporate mergers and acquisitions world, that is the ultimate praise pill for a prospective buyer.
It really is. I mean, imagine you are trying to buy a house so you can compete with your neighbor who lives in a massive mansion. You make a $9 billion offer on a property only to find out that your worst enemy already holds an unbreakable lease to the master bedroom, the kitchen, and the living room.
Yeah, you just get the hallway.
Exactly. Amazon and Apple are fierce rivals. They compete in cloud computing, streaming smart home devices. Why on earth would Amazon buy a company where their rival controls 85% of the output?
Well, if we connect this to the bigger picture, it tells us exactly what Amazon is actually purchasing. They aren't really buying satellites, and they aren't even buying network capacity.
Okay.
They are buying time. They are buying immediate regulatory compliance to satisfy that FCC deadline.
Right.
To survive in the space race, Amazon is willing to force itself to the negotiating table with Apple. Control over low Earth orbit is considered so strategically vital, whether for global logistics, autonomous vehicles, or just basic internet dominance, that Amazon will swallow the bitter pill of having a major rival dictate the terms of their new asset.
Just to ensure they don't get permanently locked out of the sky.
Exactly.
Man, so the tech companies are fighting over physical real estate in the sky, but you know what's equally crowded? The financial battleground right here on Earth.
Oh, without a doubt.
Regulators and traditional institutions are fighting just as viciously to define what money and markets even mean anymore. Let's look at this financial frontier.
The legacy systems are feeling the heat from multiple directions, and we are seeing that clash happen in real time across several different markets.
Let's start with traditional geopolitics. We are tracking reports that U.S. oil jumped over $110 a barrel, with Brent crude hitting 109.03.
Yeah, massive spike.
This massive spike came after President Trump vowed to escalate attacks on Iran. And just to pause here for you listening, our goal today isn't to take a political stance or endorse any specific policy. We're just looking at the cold, hard market data to see how the global economy reacts.
Right, impartial analysis.
Exactly. But what strikes me is that despite the geopolitical chaos, despite war breaking out and energy prices surging, the S&P 500 actually rose to 6,582.69.
Yeah, it illustrates the resilience, or, perhaps the detachment of traditional markets.
Right.
Wall Street's legacy systems are designed to absorb massive global shocks, monetize the volatility, and move on.
Right.
It's the established, legally accepted way that global conflict is traded and hedged.
But the moment you step outside that established system into the new financial frontiers, the old guard is terrified. Look at Coinbase.
Oh, this is a big deal.
The massive crypto exchange just became the first major U.S. crypto company to win a conditional national trust bank charter from the Office of the Comptroller of the Currency, the OCC.
That charter is a massive deal. Usually, a crypto firm has to navigate a fragmented, exhausting patchwork of individual state licenses.
Like state by state.
Exactly.
Yeah.
Winning an OCC charter gives Coinbase a single, unified federal regulatory status. They get to operate with a level of legitimacy previously reserved for traditional banks.
And the traditional banks are furious about it. The Independent Community Bankers of America publicly called this a grave mistake.
They're not happy.
No. Yeah. They are arguing that tech firms are getting bank-like federal status without facing the same heavy, historical, regulatory burdens that local community banks do.
Right.
But the tension over what constitutes a legitimate market doesn't stop with crypto. It is bleeding heavily into the prediction markets.
Oh, yeah. Prediction markets like Polymarket and Kalshi have exploded in popularity.
Totally.
These are platforms where people essentially place financial bets on real-world outcomes. Could be the result of a political election, who wins the Super Bowl, or even pop culture events.
And the Commodity Futures Trading Commission, the CFTC, is stepping in and aggressively asserting exclusive jurisdiction over these markets.
Yes, they are not backing down.
The CFTC is actually suing the states of Illinois, Arizona, and Connecticut. The states are trying to ban these sports event contracts, claiming it's just illegal sports gambling. But the CFTC is stepping in and saying, no, these aren't bets. These are event contracts. They fall under the Commodity Exchange Act, and we are the ones who regulate them. So I have to ask, what does this all mean? How is it that a Wall Street hedge fund buying oil futures based on a Middle East conflict is investing, but someone placing money on a real-world event on Polymarket is considered by states to be illegal gambling?
Well, this raises an important question about how society defines risk, speculation, and legitimacy. The CFTC's Director of Enforcement, David Miller, made their stance very clear.
Okay.
The federal government views these prediction contracts as swaps, which are fully legitimate financial derivatives.
Right.
But the CFTC's strategy here is brilliant.
How so?
By suing the states to protect the prediction markets from being banned, the CFTC is establishing ultimate dominance. But simultaneously, they are launching a massive crackdown on insider trading within those same prediction markets.
Wait, insider trading on a prediction market, how does that even work? Like having inside info on a football game.
Exactly that. Miller cited a very specific hypothetical. Imagine a sports trainer who has non-public knowledge of a star athlete's severe injury.
Oh, wow.
Yeah. If that trainer takes that secret information and uses it to trade an injury contract on a prediction market, the CFTC considers that the misappropriation of material non-public information. It is insider trading, plain and simple.
That is wild. They're treating a sports trainer with a secret, like a Wall Street executive with an unreleased earnings report.
Yes, and by aggressively prosecuting that behavior on platforms like Polymarket or Kalshi, the CFTC is proving they don't want to destroy these new platforms. They want to legitimize them.
Right.
They are forcing the Wild West of internet betting to conform to the strict, heavily policed rules of Wall Street. It's not a shutdown. It's a hostile takeover of a new financial frontier by a federal regulator.
It's a massive turf war. The tech companies fight over the satellites in the sky. The federal regulators fight the states over the definition of a derivative. But let's bring this all the way down to earth, to the actual consumer. We've looked at these macro-level corporate and regulatory wars, but how are these massive entities adapting to you, the listener, right now?
Because that's where it hits home.
Exactly. When we dive into the data on consumer goods, the strategy completely flips. It's not about hostile takeovers or friction. It's about removing every possible obstacle and deeply incentivizing your daily loyalty.
The divergence is fascinating. While the back-end infrastructure of the world is becoming more complex, ruthless, and automated, the front-end consumer experience is being painstakingly engineered to be as frictionless as humanly possible.
Look at healthcare. The FDA just approved Eli Lilly's new drug, Foundayo. The generic name is orforglipron.
Yeah, the oral GLP-1.
Yes, an oral GLP-1 weight loss pill. Now, for anyone who hasn't followed this science, GLP-1s are the peptides in drugs like Ozempic or Wegovy that tell your brain you are full.
Right.
Historically, they had to be injected because your stomach acid would just destroy the peptide if you swallowed it.
So making an oral version is a monumental scientific achievement. It changes the entire delivery mechanism.
Exactly. No more weekly injections, no more keeping needles in your refrigerator. The data shows this pill drops A1C, which is your average blood sugar level over a few months, by 1.3 to 1.6 points.
That's substantial.
And it drives an average 8% weight loss, which is about 16 pounds, in 40 weeks.
Yeah.
Yes, it has the typical gastrointestinal side effects of the injectables, but the friction of the needle is completely gone. You just swallow a pill with your morning coffee.
That is a massive paradigm shift for public health. The psychological barrier to entry for treating obesity and diabetes drops to zero when you move from a subcutaneous injection to a daily pill.
Right.
It completely mainstreams the medication. It integrates it into normal daily behavior.
And speaking of mainstreaming new technology, look at the auto industry. Subaru just unveiled the 2027 Getaway. This isn't some niche concept car. It's an all-electric, three-row family SUV.
An EV for the whole family.
Right. It boasts 420 horsepower, over 300 miles of range, and 8.3 inches of clearance for hitting the trails. But the absolute most crucial, friction-removing detail about this vehicle: it comes standard with a NACS charging port.
Which is incredibly significant for the consumer experience. NACS stands for the North American Charging Standard, which is the technology developed by Tesla.
It's basically the rest of the auto industry finally waving the white flag and adopting Tesla's plug as the universal standard.
Pretty much.
It means you can pull this three-row Subaru right up to Tesla's massive, reliable supercharger network. You don't need 5 different apps, 3 different adapters, and a map of broken third-party chargers to take your family on a road trip. Subaru removed the friction of range anxiety.
Subaru recognized that holding on to a proprietary charging standard or, a fragmented, unreliable network was a losing battle for consumer loyalty.
Yeah.
By fully adopting the NACS port, they are acknowledging that the ultimate battleground isn't just the horsepower or the clearance of the car itself. It's the sheer convenience of the ecosystem surrounding it. If it isn't easy, the consumer won't transition.
And finally, let's look at the literal front lines of consumer convenience Starbucks.
Oh, this is a great example.
Right. We are seeing reports that they are rolling out a massive new incentive program for their hourly partners. Baristas can now earn up to $1,200 a year in performance bonuses.
Wow.
They are moving to weekly pay to give people faster access to their earnings, and they are expanding access to tips through digital channels. All of this pushes their total pay and benefits to over $30 an hour.
That's significant for retail.
It is. And why are they spending all this money? To lower turnover and boost the customer experience.
If we synthesize these three examples, the daily weight loss pill, the universal EV charger, the barista's financial bonus, we see the master strategy at play.
Okay, tell me.
In the first half of our deep dive, we saw Oracle and Amazon fighting viciously over invisible infrastructure. I mean, laying off 30,000 people for servers, spending billions for satellites.
Right.
But Eli Lilly, Subaru, and Starbucks realized something vital. The companies that actually win the consumer's wallet are the ones that perfect the tangible daily human interaction.
Because it removes the friction.
Exactly. Starbucks knows that a financially stressed, constantly rotating staff leads to a miserable morning coffee run for you. By heavily investing in their frontline human capital, they're removing the friction of a bad experience.
It really is incredible when you pull back and look at the whole picture. We have covered massive ground today.
We really have.
We started with the sheer brutality of Oracle's automated 6 a.m. layoff of 30,000 human beings just to fund their AI data centers. We unpacked how the coding community is using AI to alter the syntax of Anthropic's leaked code to dodge copyright bots.
The Spanish and French analogy.
Right. We looked up to the skies to see Amazon desperately swallowing a poison pill with Apple just to buy Global Star's satellites and beat an FCC deadline.
Buying time.
Buying time. We navigated the regulatory minefield, watching Wall Street shrug off $110 oil, while the CFTC fights the states to legitimize prediction markets by policing them for insider trading.
Huge turf war.
And we brought it right back down to your living room. The medicine you can just swallow, the electric SUV you can charge anywhere, and the barista who's finally incentivized to make sure your day starts right.
You are watching a historic reallocation of money, power, and priorities.
Yeah.
Whether it is the geopolitical ripple effects of oil prices dictating traditional markets or a federal regulator stepping in to protect your event contracts, these massive unseen gears are turning the reality you interact with every single day.
You are living inside the construction zone of the future. But as we wrap up this deep dive, there is one final provocative thought that I think we really need to leave you with as you go about your day.
Yeah, I think we have to look back at the contrast we've painted today. We saw Oracle fire 30,000 human beings, viewing them as entirely expendable compared to the value of AI servers and compute power.
Right.
We saw Anthropic accidentally leak an AI that includes a Tamagotchi-style buddy, explicitly designed to keep you emotionally engaged.
Yeah, the digital head pats.
Exactly. Our corporate infrastructure is becoming increasingly automated, increasingly synthetic, and completely devoid of actual people. So here's the question you have to mull over.
Okay.
As the world becomes run by autonomous agents and cold, quiet server farms, will the companies that heavily invest in the human touch like Starbucks paying a premium to ensure you are greeted by a happy, stable, real-life barista become the ultimate luxury of the future? Is genuine human interaction about to become the next scarce commodity?
It really makes you wonder, if the world's biggest corporations are bringing a wrecking ball into your living room just to build a server farm, maybe the most valuable thing left in the house is the person sitting across from you.